Welcome to the Real Estate Way to Wealth and Freedom podcast with Jacob Ayers, providing actionable content to help you along your journey to financial freedom through real estate investing. As the premier asset class, real estate has helped ordinary people just like you amass fortunes. The benefits of passive income from real estate investing will allow you to live a life you want. And now your host, entrepreneur, real estate investor, and apartment deal syndicator, Jacob Ayers.
Hi, and welcome to the Real Estate Way to Wealth and Freedom podcast. Today, our guest is Ivan Barratt, founder and CEO of Barratt Asset Management. Ivan is a multifamily owner and syndicator who specializes in FHA and agency financed projects. Since 2010, Ivan has raised over $20 million in equity, acquired over 1,200 units, and grown Barratt Asset Management to best-in-class management company. Today, Ivan focuses his time on equity finance, acquisitions, and human capital. Currently, his companies manage well over $100 million in assets, comprising over 1,700 units. I'm excited to have Ivan Barratt on the show today. Ivan, thanks for joining us.
Hey, thanks for having me, Jacob. Appreciate it.
Absolutely. Ivan, so can you tell the audience a little bit about yourself and how you got started investing in real estate?
Absolutely. Well, thank you for the warm introduction. It's a pleasure to be here and be on the show and share a little bit. I'm a pretty fortunate guy. I'm 39 now. When I was 7 years old, your dad could not be reported to child services or arrested for making you do manual labor. So my brother and I, we spent a lot of time mowing yards, pulling weeds, and doing various menial labor jobs at his rental properties. He's an attorney, but owned a handful of rentals growing up. And so I got a taste for it early and also a disdain for manual labor. And as I approached college, I thought, hey, why wouldn't you just want to own a bunch of real estate? You know, it sounds better than getting a real job. Well, fast forward, it is a real job, but I do enjoy it, and started with one little duplex that I lived in one side and rented out the other, and a few more details in between. But now, like you said, we're about 1,700 units under management, and we've got a pretty busy fourth quarter. 2 deals comprising 540 units, about $45 million total acquisition price will put us over 2,000.
Wow, that's awesome.
Thank you.
So, Ivan, how did you grow your portfolio from starting out in your duplex to where you are now? What did that look like, and what was your journey? What was your path to such rapid success?
Yeah, the first deal's the hardest. I just got out of college, and I'd taken some real estate courses in college, read some books, read Rich Dad Poor Dad when it came out. My father gave me that book. He's a big fan of it, and said, hey, don't be an attorney like me. Be an entrepreneur and hire a great attorney. That first one, I took advantage of FHA financing on the owner-occupant side and was able to scrape together 3.5%. And I bought a duplex in a good neighborhood in my own city, moved into one side and started renting out the other. I've done everything, started a management company in 2010 and got real serious about it. It's just putting one foot in front of the other and saying, okay, how am I going to get that next deal done? Never did single families, though. Always said I'll buy a multifamily as long as it's 2 or more units, And the next stage for me was finding distressed small multifamilies, a 3-unit, a bunch of duplexes. My first big deal was a 6-unit, and I was buying distressed assets that were either very physically distressed and or had a distressed seller. This was back in the Great Recession. And I would use hard money to fix them up, lease them up. And, back then we didn't have the BRRRR method as referred to on Bigger Pockets, but that's basically what I would do with my sites on apartments. So from 6, I jumped to 35, had to find some capital on the equity side. So I had to learn about bringing in a partner and building relationships and selling people on the idea of investing in apartments. And from there, kept growing and kept scaling.
Yeah, awesome. And Ivan, I think that's a phenomenal way for a lot of people listening out there to get started is, buy a small multifamily, live in one side. You got that low down payment. It's a philosophy we talk a lot about here on the show, and just goes to show that it does work. If somebody like you has done it and, has taken their portfolio to enormous levels. So yeah, great stuff.
Yeah, it takes a little bit longer. It doesn't happen overnight, but you get going and you get momentum and you fail early. And you fail on small deals. And when I say fail, I mean make little mistakes and learn lessons and learn as you go. So that by the time you're doing bigger deals, you really know more about what you're doing and you've got a better knowledge base to build from.
Yeah. So, Ivan, what was it about multifamily investing that drew you to it? I mean, you had some background. Your dad had some rent houses, some rental properties. What was it that kind of drew you to these larger multifamily deals?
Well, real estate in general, like most people that have the bug and that probably listen to your podcast and are out there figuring out, what to do and how to do it. The attraction was the long-term wealth generation, but also finding a way to have reoccurring cash flow now and to have something that can help take care of my monthly expenses. Wife and 3 kids are definitely not cheap, and we like our freedom and travel and things of that nature. So I had to build a business around it. And at the same time, the scalability of multifamily allows me to reinvest that cash flow and keep doing more deals and grow that wealth bucket. Why I like multifamily, and we really play in that rental band in the Midwest in our markets around here of about, say, $600 and maxing out around $1,200 a month. So we do what's called workforce housing. We buy existing projects, mostly B assets, some in that middle C range in very good locations. Essentially always going to have renters if you treat the tenants, the residents well, and if you maintain those properties. In recessions, they do better. So in other words, we stay away from all the other asset classes in real estate, retail, industrial, office. And then we even bifurcate further apartments. We don't do student, we don't do high end, and we don't go to the hood.
So right there in the middle of the road, you've kind of got your sweet spot, it sounds.
Yeah. It right now it takes a lot of deals through the pipeline. We have to underwrite about 150 opportunities to find one good one because we're not the only ones that like that model. But if you can block and tackle and understand it's a numbers game, and I've got a team that under me that helps support the deal flow and the underwriting, we think it's the highest return you can get with the lowest amount of risk, and the financing at that level is better. Again, the ability to raise rent, the protection of the downside from market corrections. Again, we firmly believe it's the best, what we call risk-adjusted return out there.
Yeah,
workforce
great.
apartment.
Now, Ivan, people may kind of gloss over when you say we have to look at 150 deals in order to get one. That's a lot of work to sift through, underwrite all these deals. Could you talk about that process and how you and your team have, come up with systems and things to kind of make that process easier for you?
Oh, sure. Absolutely. I would first say, though, that if you're just getting started and you haven't looked at 100 deals and you think you have a deal, it's not necessarily that you don't, but it's a red flag. And I'm not the first guy preaching this. A lot of good educators out there will tell you, you got to look at a lot of properties before you can really, from a gut, sniff out a good deal. Fast forward to today, I've got a business partner, former multifamily broker for 6 years, has done a couple $100 million in transactions, opposite of me. And what I say by opposite of me is he's not quite as good looking as I am, but he's 10 times smarter.
Brains are broad, you get one or the other.
That's right. And he's what I would call a very capable technician. He knows what everything costs to run. He knows the ins and outs of different vintages or properties built in different time periods. And he's got the mind of a steel trap. And he stays in his lane. He takes the first brush at all the properties. I get involved when they're a little further into the pipeline. I spend most of my time raising capital for projects and finding good people for our team. And speaking of that, he has other folks under him. Now, we've got a lot of good teammates in-house. We've got a head of construction and maintenance, and that's his whole background is apartment construction, renovation, maintenance. We've got a whole management team, a hierarchy of asset management all the way down to the property level. And then what makes us go, because we do use a lot of government financing, HUD, agency debt, we've got in-house accounting, administration, internal operations, investor relations, that sort of thing.
Yeah, so Ivan, some things I'd like to really nail down on are the finance side of things. So you've mentioned raising capital. You started out with that duplex, with an FHA loan. It sounds like you've kind of played in the small multifamily arena for a while and then started raising money for larger deals. So when did you transition to raising money?
Well, that's a great question, Jacob. Even early on, when I was going out there and wanting to do the BRRRR method before it was coined that, I had to sell the good hard money lender on my projects, right? Because I didn't have a lot of money to put down. So I had to sell them on how great of a deal it was in order to get financed that way. Mm-hmm. As we got into bigger projects, I used the power of networking and relationship building to go out there and find capital for deals. And as we got larger and more momentum, it became imperative to continue to increase that network of investors. Also, because we're a property management company and we manage for other people, I have management clients that started out with me on some of their own small deals. And then once they learn what we're doing on a larger scale and there's already a level of trust there, it's an easy jump to participating in our professionally managed projects where they have a little bit more of a passive role.
Yeah, okay. Yeah, that makes sense. So did Barratt Asset Management start out as a management company, or were you more on the acquisition side at first?
No, so my ability to get more deals was predicated on having more cash coming in. I had just gone through the Great Recession, right? Learned a lot of lessons, was working for a developer before I had started my own company and had a front row seat to the crash. I was actually 6 figures in debt, owned some properties that didn't cash flow, almost 200 grand in debt. And I was in my mid 20s and my girlfriend, now wife, was with me. Her father-in-law actually recommended I file for bankruptcy, which I refused to do. Ended up crawling my way out of it. And the reason I say all that is because I needed a way to generate income. So I started a management company and I started managing property for other folks that either couldn't sell their house. So back then I was doing single family management, condos, townhomes, duplexes, anything I could get my hands on that I didn't have to carry a gun.
Okay.
And so that helped me. It was hard, but it helped me build this management platform, which is the critical piece to scaling apartments, because they are great when you know what you're doing, but they are easier to screw up if you don't.
Yeah, really good.
So
point.
the management company is really what helped me build a track record, build credibility, and also build income in order to reinvest in that business, but also into my own deals.
Yeah, so that management company was really your base, kind of your bread and butter that got things started for you and gave you the opportunities to start doing your own deals.
Absolutely. And now at a 45 employees, 40 of them are full-time on the management or maintenance side of the org chart.
Yeah, okay. So Ivan, let's talk about what kind of deals you've got going on now. I noticed, I recall that you mentioned having 2 deals in upcoming closing totaling around 540 units. Could you talk about some of those current projects you have going on?
Yeah, absolutely. My last 3 projects, and for a while now, we've only been doing on-site staff acquisition. So last few have been 200, 237, 250. We'll close on 302 units, either right before or right after Thanksgiving. And then for tax reasons for the seller, we'll close on another 240 the first week of January. One project is in Dayton, Ohio, which will be our first out-of-state acquisition, about 2 hours from Indy. It's a market we've been hunting in for the better part of the year. Couldn't be more excited to get over there. A suburb of Dayton, high growth corridor between Dayton and Cincinnati, B+ asset in an A area, and not a big value add. We'll do very, very light value add. We're basically purchasing a very stable project, and we're acquiring a long-term income stream with a very defensible downside. What I mean by that is there's not a lot left to do there. And we can still get double-digit returns, but we're not taking a lot of risk doing a heavy value add.
Yeah, okay. Is value add something a lot of times what you guys are looking for in properties?
It's thrown around a lot these days. We typically look for some sort of value add. But value add used to be where you're going in and you're spending $7,500, $10,000 a door. But in this case, we might spend closer to $2,000 a door over the first 2 years of ownership.
Okay.
We're just making a few minor changes, upgrading a couple amenities, some very light cosmetic stuff as units turn over, but it's already a B+ asset in a very desirable location. We're buying it from a developer that's already done a $3 million renovation to the property. So they want to take that capital and recycle it. Me and my investors want the long-term income stream. We want the cash flow.
Yeah, right. Okay. Makes sense.
The one we're doing in Indy is a little heavier value add, not much, still what we would call light value add. 240 units, B- property in another A location here in Indianapolis, Indiana, which is extremely tough to find a good deal. We've lost out a lot this year on finding projects, but we finally got one to work.
Yeah, right. So talking about markets, Barry, you guys focus primarily in Indianapolis and then the surrounding community. Where else have you guys invested?
We invested all over Indiana. We really like tertiary markets in the Indianapolis solar system. So other smaller cities within an hour of Indianapolis that have 70, 80, 100,000 people in diverse economies. We can get better rates of return there. And so we're in little cities like Evansville, Indiana, Bloomington, which is where Indiana University is, and a few other little markets like that. And then a market like Dayton, Ohio, which is right around $1 million inside the MSA.
Yeah, right. Okay.
In Indianapolis directly, it's on everybody's radar. It's a very hot market right now in the Midwest. Still opportunities, just a little more difficult to uncover.
Yeah, right. So, Ivan, what are some things you and your team at Barratt Asset Management look for in properties that you guys are acquiring?
Sure. At the high altitude, 100,000 foot view, we look for a going in cash on cash return somewhere between 8, 11, 12%, depending on the age of the asset and what we have to do to it. We look to get a double digit IRR, 15 to 20%, and our goal is to triple our money over a longer term 7 to 10 year hold. We either use Fannie Freddie debt, or we've got our own little niche of using HUD financing, which not a lot of people can get. You can use it for market rate property. People hear HUD and they think I'm doing Section 8. It's actually not true. That's a myth. But it offers 35 years fixed for the entire length of the loan. And right now, rates in the mid to high threes.
Wow, let's nail down on that HUD program that you're speaking of, because like you said, it's kind of got a negative connotation. Sometimes people associate Section 8 with it. Tell us a little more about that.
Sure. So I'm sure a lot of your audience that does apartments is familiar with Fannie and Freddie. That's what we call our agency lenders, right? You get 10-year terms, 30-year amortization, typically 75 to 80% loan to value, most of the time 75%. HUD is another factor of 5 in terms of brain damage. It's a heavy regulated compliance type loan. Mm-hmm. I get audited once a year. I have to turn in financials every month. They physically audit the property every 3 years. It's very cumbersome to deal with. But if you can navigate that, you get 85% leverage, currently in the low threes. And here's the crux. It's 85% leverage on acquisition, renovation, and replacement reserves. Wow. So in other words, if you are doing a heavier rehab, $5,000 a door, $7,500 or more, you can finance those rehab dollars through the HUD program, which, as you can imagine, with that kind of leverage, it allows us to deliver superior returns to our investors.
Yeah,
so
definitely.
Tons of brain damage. But if you've got the right team, very worth it. Very worth it.
Yeah, sounds like it. That 85% loan to value ratio that you mentioned is something that's very rare in today's lending environment.
I wouldn't even do it because typically that high of a leverage is a higher risk. However, it's a 35-year loan and it's what we call full AM. Nobody else does this. It's a 35-year amortization. You can still get out of it in 5 or 10 years depending on what you pay. However, you can weather any economic storm with a 35-year amortization and 35-year fixed note. So a lot of the bigger multifamily shops that understand this financing use it and hold long term because there's nothing else that comes close to it.
So there
you need at least 100 units though to make sense.
There is a prepayment penalty on this loan product though.
Well, if you know what you're doing, it's either a 10-year prepayment. However, you can pay 25 basis points, 0.25%, and knock that down to 5 years. And right now, even with that extra 0.25%, my last HUD deal was 3.65 interest.
Wow. Yeah, that's phenomenally low.
Yeah. Well, they have a mandate. Just as Fannie and Freddie, they want to help provide private developers and capitalists the capital they need to offer safe, clean, affordable housing to the vast majority of folks out there that will be renters for life.
Yeah, right. Well, Ivan, let's switch gears here a little bit and talk about what kind of advice do you have for the listeners who are looking at raising money for maybe their first deal or maybe their first few deals. Kind of take yourself back to that time and point in your career when you were coming up with money for your first apartment deal. What advice would you have to the listeners in that kind of time frame?
I think a lot of people out there have much more money in their network than they realize. And spending time on learning how to network, picking up a couple sales courses on how to sell and how to prospect and how to do that the right way can add a lot of value to your capital raising efforts. I spend very little time now reading real estate books. Most of the books that I read or reread are self-development and sales. It's the number one skill for raising capital. You have to know the deals. You have to understand real estate finance. You have to understand your project. And what also helps tremendously is finding a good deal. But getting out there ahead of that and having conversations with folks, letting them know what you're doing, why you're doing it, and remembering that not only is there more capital in your network than you realize, but there's more capital in your network's network. I can't tell you how many people have come to me via an introduction from somebody that just wants to help me.
Yeah, that's awesome. I ask this because raising capital seems like one of the more intimidating things in real estate syndication for beginning investors. So just getting that insight,
Sure.
what helps, what skills you should have, how to go about it is really valuable.
Yeah. In my first few deals, I didn't have some sexy pitch deck. I didn't have a super sexy deal right there to show people. I wasn't slick and polished. It's just having those conversations, getting your at-bats, getting up to the plate and swinging the ball, practice, repetition, and it is sales. The better you can get at dealing with rejection and getting right back up and going to the next person, the better chances you are of raising capital. If you're not that guy, like my partner, then you need to partner with a guy like me. Right? He stays in his lane and I stay in mine, but I wasn't born a great salesperson. I didn't do this because I love sales, but I figured out how to learn in the science of sales, and I'm just more practiced now.
Yeah, right.
It's repetition. It's education. I spend a lot of my time in the car listening to good content on sales, self-development, self-improvement, more so now than I do real estate technical education. But if you're just getting started, I would say it needs to be split half on real estate finance and putting together apartment deals. And the other half should be on sales. Got to give a shout out to Grant Cardone. He's a wild man.
Yes.
He is a wild man, but his books, If You're Not First, You're Last, Be Obsessed or Be Average, those are some of my favorites. I've probably read If You're Not First, You're... I like Sell or Be Sold, but if I was going to pick one, I think I've read If You're Not First, You're Last 5 times.
Okay.
It's great sales training. It's motivating. It'll keep you pumped. And there's real, what I would call meat in there on how to prospect and how to sell to people. And the best part is if you can find deals that you know are good for folks, it's easier to sell something you're passionate about.
Yeah, that's definitely true. Well, Ivan, when we're talking about raising capital, earlier you mentioned raising capital for equity. Can you talk about what the difference between raising capital for equity versus debt is?
Yeah, debt is, it's a similar sell. A bank or a private lender, they want to see a business plan. They want to see who your team is. They want to see what your exit strategy is. They want to know that you've done your homework, and they don't expect you to be a jack of all trades, but they expect you to have those gaps filled. So in my market, somebody might say, well, BAM's my property management company, and they've actually done the renovation quotes, and this is what it's going to cost. And we did a market study, and we think we can get these rents. It doesn't have to be this 30-page thing, but if you walk into their office or email them a plan and get on a call, you're going to be 95% ahead of your competition.
Yeah, okay, that makes sense.
Same thing if on the first few deals that I did, a 30-unit apartment building, a 15, then a 35, and a 60, I went to a mortgage broker of sorts, and he helped me put a debt package together, and we shopped it to a lot of community banks in my region. And rather than me going to one bank with my hand out saying, can I have some money, please, changed the perspective to going out to 13 banks and saying, who wants to loan on my apartment deal? And just that little shift, he charged a point for it on the debt. So the deal, it was baked into the deal. But just that little shift made all the difference. And then I used his debt package and I just stuck it in front of some investors and said, hey, this is the deal I'm doing. I'm looking for this much in capital. I can pay you this much and you get this percentage of the deal. What do you think? And I was off to the races. Over time, our decks have improved, my pitch has improved, and our reach and our influence and our network has improved. But a lot of it takes just getting started and getting that momentum.
Yeah, right. So in this relationship, the bank or hard money lender or whoever that may be acts as your debt partner, and your capital from your investors are your equity partners.
So on the private money deals, and I'm reluctant to talk too long on these because they're harder to find right now. But in the Great Recession, I was finding such great deals that I didn't need to put more than $5,000 down on a few $100,000 because there was so much upside that the private lender was able to loan me acquisition, renovation, and float my interest for 6 months because the deals were so good and I did a good job of showing them the plan. The next level, when you're buying apartment complexes, unless you're coming up with all the money yourself, which is the slow way to get rich, the very slow way, you're convincing lenders, which is a lower bar because lenders like apartments. And then you're going out into your own network or people who may know somebody that you know, and you're raising that equity in a more standardized syndication model. In the beginning, though, with 1 or 2 partners that I had already had an established relationship with, you don't have to do a full-blown syndication per se. Obviously, I have to say check with your attorney, but we just did an operating agreement. There was no need to do a full private placement memorandum.
Yeah, right. Being that it's just a small pool of, maybe a few investors pulling their funds together.
Investors that I had a long established relationship with. Yeah. Yeah. And again, if people really start thinking about everybody that they know, I guarantee you 100% of your audience, there is more capital in the network of people they know than they think.
Yeah, I'm sure of it.
There always is. There always is. It's just getting that momentum and that confidence to go out there and show people what you're doing.
Yeah, very true, Ivan. Well, Ivan, let's talk about some of your best and worst deals you've had over the years. With nearing 2,000 units now, I'm sure you've had some great deals and some not so great deals. So could you take us through that journey and give us an idea of maybe a really good deal and a really bad deal you've experienced?
Yeah. I'll talk about a bad deal first. And the good news about apartments is even a bad deal can still turn out to be pretty good if you do your homework. But one of the deals that hasn't done great, a bunch of things that could happen did happen. So it hasn't gone as well as I'd hoped. A 60-unit project. It's still clipping a 7% return to myself and a few partners. That one, we paid a little bit too much for it. We had a lot more tenant turnover, a lot more deferred maintenance than we thought we'd have. And we made the mistake of thinking that we would do all these improvements out of cash flow. Big mistake. Luckily, it was only 60 units. It didn't sink me. Again, now it's generating a 7 or an 8%, I can't remember, cash on cash return. We were just able to refinance it onto a Freddie small balance deal. So we refilled the replacement reserve and we're in good shape again. The worst deals I would say are the ones that I had a front seat to, but not a lot of ownership in, just a small percentage back in the last real estate hot market when I was working with a developer. And that was how not to do real estate. It was all speculation based on the developing building and somebody buying it. So luckily for me, I feel very fortunate to have been slapped in the face by God or the universe, whoever you want to language that,
right,
very early in my real estate career. And it reminded me to focus on cash flow first, not appreciation.
So when you said you guys were focusing on the cash flow to fund these renovations in this property, what went wrong there? And should you have done something different?
Now we do a much more comprehensive inspection. We hire third-party consultants that are a little more expensive, but do a much more thorough physical conditions assessment of the property. And if there's roofs that need to be replaced, a parking lot that needs to be restriped, cosmetic improvements to common areas or units, if we can't finance that up front, either through debt or equity, we don't do the deal.
Yeah. Okay.
Yeah. We don't go, we'll just make a little improvement along the way through cash flow. It's a recipe for disaster on a lot of properties, especially C properties. Learning the true costs of running a C property, the true needs of replacement reserves is critical. You're going to get smoked if you don't know what you're doing on those deals.
Yeah, and on those C properties, obviously by definition, they're a little bit of older property. So what are you doing to bring those up to a certain point? If you're going to do renovations before you buy the property, do you bring it up to, B level or what are you doing there? What kind of baseline do you look for there?
We're very disciplined about the location first. So if it's a true C plus, it's got to be in a B or better location. A good school district. We don't buy C properties that aren't in good school districts. It's a bad idea. Again, we stay out of the hood. But there's even areas that look nice on the surface. But if families with kids don't want to be there because of the schools, you've got a big swath of a market that won't rent from you, right?
Yeah, right. Mm-hmm.
On the renovation side, we're much more experienced, aware, and conservative on what it's going to take to maintain that property. Going from a C to a C plus or a C plus to a B minus is achievable if you know what you're doing. But if you think you're going to take a C to a B, unless it's in an extremely nice location, it's probably not feasible. You have to be careful of overdoing it on properties. You can certainly spend too much on the improvements if that's what you were sort of asking.
Yeah, that's kind of what I was getting at. If you've got like this C property, you're obviously not going to go in and try to turn it into an A. So where do you stop and, where are you baselining,
Sure. It's deal specific. Yeah, it's deal specific. Depends on the community. We like our C properties. We just know what it takes to run them. And then we play in that B space too, which the returns are a little bit less. You pay a little bit more, but the rents are higher. The buildings are newer. So that cash flow is a little safer.
Yeah, good. I think you made a good point that in apartment investing, even bad deals can sometimes turn out to be not so bad and maybe even good. So, on this bad deal, you guys are still making a 7-8% return, whatever it is, and you haven't lost anything. And
a lot of real estate out there where that's not the case. There's a lot of real estate where if you make an incorrect prediction, you lose all your money.
Yeah, very true. Well, how about on the flip side?
And you can be on the hook for the difference.
Yeah, there you go.
Best deal so far will be is actually a C property we bought about 45 minutes outside the city in the city of Anderson. On paper, it's one of the best deals so far. We will refinance it here in a few months. We will do a cash out refi, so to speak, and we will double our investors' money. So we'll have no more capital in the deal and still own it long term.
Yeah,
and it
awesome.
will still be
What
cash
was the
flow
duration
positive.
you held that for?
We bought that property 2 years ago this February. So that at the 2-year mark, I can refinance it on agency debt. After 2 years of ownership, I can get better leverage. And our loan proceeds will double our investors' initial contributions.
Yeah, awesome. That's great.
And we've been making distributions every quarter since we've owned it.
Yeah, that's phenomenal. Awesome deal. I'm sure your investors are happy with deals like that, and that keeps them coming back.
It does. It's a lot easier to keep the investors you have than to always look for new ones.
Yeah, certainly. So, Ivan, we've kind of talked about it earlier in the show, but kind of tell us a little bit about how you've built your team and what kind of things you were looking for when you were building this management company, turning into some acquisitions. How exactly have you done that up to this point?
I've made every mistake you can possibly think of, Jacob.
Well, let's hear a few.
Yeah. So when I started off, I was doing everything myself. So I've hired and fired and hired and fired all my way to where we're at now. A few years ago, as we got a little bit bigger, I really started focusing on our culture and getting better people. And I learned a secret sauce that I'll share with you is promise not to tell anybody.
Oh, absolutely. Just
between you and me. If you pay a little bit more, you tend to get better people who stick around longer and do a better job.
Doesn't sound so complicated.
The people now in this business are really what makes it go, almost more than I do. Putting the right people in the right spots in management, construction, accounting, investor relations, customer service really has been the catalyst to our growth curve bending a little bit faster on the upside.
Yeah, good. All right.
Yeah. And then externally, I believe Rich Dad had a great saying, pay your brokers well, paying your attorneys, your brokers, those outside vendors that are working hard for you. All those relationships are mission critical to a successful process, a successful acquisition. Broker relationships are a lot these days. So we treat them like gold. Our maintenance and construction team are so important to us. They do such a good job. They're worth their weight in gold. Easy what they have to go through on a daily basis. They really make us look great. Our people at the office, we've got a saying, we call it the BAM fam. We communicate well. We have employee events and we train hard and we play hard. And it's a beautiful thing to watch from someone who started off in his spare bedroom and now approaching 145 million in assets under management and closing on these 2 deals that'll take us a little north of 50 employees.
Yeah, that's awesome. That's great stuff. So, Ivan, you're approaching great levels of success with your real estate. So what are your future goals with everything?
20,000 units, rinse and repeat, keep doing the same thing I'm doing and continue to expand geographically.
Yeah, awesome. Almost 10xing from where you're at now, it sounds.
Yeah, that's the goal. I'm an ADD scatterbrain type of guy. I work really hard to keep my blinders on and keeping the squirrels out of my sight, shiny objects out of my line of sight. And I am firmly implanted in the school of thought that you should focus on one formula and work to do that formula very, very well, to execute that very, very well. I see a lot of people trying to do a bunch of different things in real estate at once, and they end up being mediocre at best or at worst failing on all of them.
Yeah, right. Well, Ivan, what are your reasons why going forward?
Yeah, my big why is my financial freedom and my family's financial freedom, leaving something to my kids and their kids and grandkids and so on down the line. I'm keenly interested in dynastic wealth and a legacy. And selfishly, I want to do what I want, when I want, how I want, for as long as I want, and with whom I want, whenever I want.
I like it. There you go. Good stuff.
Thank you.
Well, Ivan, as we're wrapping up here, we've got a lightning round, just a series of questions that we'd like to fire at you and you just answer from the hip. How's that sound?
Let's roll.
Okay, here we go. All right, our first question is, what was your biggest hurdle getting started investing in real estate and how did you overcome it?
Fear and analysis paralysis. Solution, focusing on momentum and building that momentum and coming to the realization that you'll never have all the information. And if you try to get everything, somebody will beat you to the punch every time. If you've got 80% of the information, make the offer.
Yeah, awesome. Okay, good. Ivan, do you have a personal habit that contributes to your success?
Yeah, we talked about it earlier. I force myself 5, 10, 15 minutes a day, any little bit of time I get in the car, doing the dishes, whatever it is, listening to really good content on self-development, sales, a little bit of real estate.
Yeah, awesome. I like it. I think self-education is the best investment you can make in yourself. So
invest there first.
There you go. All right, Ivan, do you have an online resource that you find valuable?
I like podcasts like yours. I like I get on Bigger Pockets. It's fun to be on there and learn from others. I'm a huge Audible.com and Stitcher fan.
Yeah, okay, good. What book would you recommend to the listeners and why?
Well, I usually won't recommend a book until somebody's told me the last 3 books they've read, so I can get a better idea what their next step should be. But I'll give you one that's one of my all-time favorites. It's Maverick Real Estate Financing: The Art of Raising Capital and Owning Properties Like Ross, Sanders, and Carey by Steve Bergsman.
Okay, that's a new one.
No Audible version on that one, but you can find it on Amazon. Maverick Real Estate Financing.
Okay, cool. We'll link that in the show notes for our listeners to find. All right, Ivan, last question. If you were to give advice to your 20-year-old self to get started investing in real estate, what would it be?
Oh, gosh, that's easy. I would tell him all the things I figured out at 30, focusing on the cash flow and doing what I started doing right around when I turned 30. Yeah, I would have gotten this started way earlier.
Awesome.
And I would have probably literally would have kicked him in the ass once or twice.
Good. Okay. Good stuff. Well, yeah, I think that's a common philosophy amongst real estate investors is they always wish they would have started sooner. So
absolutely.
All right, Ivan, as we're wrapping up here, where can our audience find more about you and connect with you if they have any further questions?
Yeah, if you spell my name right, it's easy to find me. Ivan Barratt, Barratt, via Google. I'll give you my phone number if you don't share it with anybody else. Just kidding. 317-590-1978, ivanbarratt.com or barrattassetmanagement.com. I'm easy to find.
All right, Ivan. Well, thank you so much for the interview today. We'll link all your contact information in the show notes if our audience has any questions or wants to reach out for you for anything else.
Have me back anytime, Jacob. It was a real pleasure.
All right, Ivan. Thanks. Take care.
You too.
Well, what a great interview from our guest today, Ivan Barratt. I think it's important to realize that Ivan, just like many people out there, started small by buying his first duplex, and through hard work and dedication, built his portfolio to over 2,000 units. Ivan provided a ton of great, actionable content and has given us some stories and insight to his journey so that you can use his success to model your own. I hope you're getting value out of this show. If you have any questions or comments, or would like to hear something or someone specific on the show, reach out to me. You can contact me at www.jacobayers.com/contact or connect with me on Facebook at The Real Estate Way to Wealth and Freedom. Till next week, signing off, I'm your host, Jacob Ayers.
You've been listening to the Real Estate Way to Wealth and Freedom podcast, providing you actionable content to build your real estate empire. Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for personal advice. The opinions of guests are their own. Information is not guaranteed. All investment strategies have a potential for profit or loss. The host is operating on behalf of the Real Estate Way to Wealth and Freedom, LLC, exclusively.